Drenard Trust here. In this video, I'm going to break down a multitude of strategies that you can use to help you save thousands on a home loan. So we're going to first start with a good credit score, right? A good credit score is one of the most powerful tools home buyers have to reduce the cost of a mortgage. Now, here's how it translates into significant savings. You have lower interest rates, mean lower payments. So lenders use your credit score to determine the interest rate they offer on a mortgage. So higher scores signal lower risk, so you're rewarded with lower rates and fees. For example, a borrower with a credit score in the 760 to 850 range could qualify for an average rate of around 6.45%, while someone with a score between 620 and 639 might pay around 8% for the same 30-year, $300,000 loan. Lifetime savings can be substantial. Raising your credit score from fair, which is around 580 to 669, to very good, which is 740 to 799, can save you over $31,000 on a typical mortgage, according to recent LendingTree data. So the difference in interest rates between credit bands might seem small, often 0.2 to 0.4 percentage points, but because mortgages are large and long-term, even a fraction of a percent can mean tens of thousands saved. Now, the reason why the savings are so large, mortgages involve borrowing hundreds of thousands of dollars for decades. So small differences in rates are multiplied over time, making the impact of a good credit score especially, pronounced for home loans. Before I proceed, hit that subscribe button and the like button right now. If you're enjoying this content so far, please hit that subscribe button and the like button right now. So borrowers with fair credit can pay 7% more in interest on their mortgages than those with very good credit. Now, here's how you can leverage your credit score for maximum savings. You can shop around. Even with a good score, compare offers from multiple lenders to find the best rate. Take steps to improve your score before applying. So pay bills on time, reduce credit card balances, and check your credit report for errors. Here's the bottom line in regards to this strategy. A strong credit score doesn't just help you qualify for a mortgage, it can help you save thousands or even over $100,000 over the life of your loan by securing a lower interest rate and smaller monthly payments. Now, let's get into the next way. You can reduce your loan amount. So the more you put down up front, the less you need to borrow. This immediately lowers your principal balance, resulting in smaller monthly payments and less interest paid over time. So basically, lower your interest rate. So lenders often view borrowers who make large down payments as less risky, which can qualify you for a lower interest rate. So even a modest reduction in your rate can translate into significant long-term savings. For example, on a $300,000 mortgage, reducing your rate by just 0.5% could save you more than $28,000 over 30 years. So basically reduces total interest paid, right? So by combining a smaller amount with a lower interest rate, you pay much less in interest over the life of your mortgage. For instance, or for example, doubling a down payment from 10% to 20% on a $500,000, home could save you over $96,000 in principal and interest combined over 30 years. It basically helps you avoid mortgage insurance, like the PMI. If you put down at least 20% on a conventional loan, you typically avoid private mortgage insurance, which can add hundreds of dollars to your monthly payment. Eliminating PMI directly reduces your monthly and overall costs. You can increase your home equity immediately with the strategy as well. So a larger down payment gives you more immediate equity in your home, which can protect you if property values drop and may allow you to borrow against your home in the future. Now, let's look at the next way. Shopping around for a mortgage and comparing lenders is one of the most effective ways to save substantial money on home loans. We talked about this, but let's break it down even more. There is direct financial savings, so lower interest rates, right? different lenders offer different mortgage rates to the same borrower, right? Even a small difference in your interest rate can translate into significant savings over the life of the loan. For example, a LendingTree analysis found that by comparing offers and choosing the lowest APR, borrowers could save an average of $76,410 over a 30-year loan, about $212 per month, and $2,547 per year. In regards to annual savings, Freddie Mac found that getting quotes from at least 2 lenders could save you up to $600 a year, while quotes from 4 lenders could save you up to $1,200 annually. There are state-specific savings as well. In high-cost states like California, New Jersey, and Hawaii, shopping around could save borrowers over $100,000 during the life of their loan. Now, it's basically more than just rates, right? Fees and closing costs play a factor. So lenders charge different fees in origination, application, and closing. Comparing these costs can help you avoid unnecessary expenses and find the most affordable option. So loan terms and features play a factor in this as well. So the lowest rate isn't always the best deal. You should always compare the annual percentage rate, also known as APR, loan terms, and any special features or programs that may benefit you at that time. Now, here is how to shop effectively. You want to get multiple quotes. So experts recommend obtaining quotes from at least 3 to 5 lenders, 3 to 5. That includes credit unions, banks, mortgage brokers, and online lenders. Then compare on the same day. So since rates fluctuate daily, compare offers on the same day to ensure accuracy. You're going to want to review full loan estimates. So ask each lender for a detailed loan estimate, which should include all costs, rates, and fees. This makes it easier to compare apples to apples, right? Then, time your application. So complete your mortgage shopping within a 45-day window to minimize the impact on your credit score from multiple inquiries. Here's why lenders differ, in regards to business models and more. So online lenders often have lower overhead and may offer more competitive rates and lower fees than traditional banks. You have specialization. So some lenders specialize in certain loan types or cater to specific borrower profiles, which can lead to better terms for your unique situation. Now, here are the banks and lenders with affordable home loans, right? So I'm going to make it a little easier for you. So you have DHI Mortgage, which currently offers some of the lowest mortgage rates starting at 5.33%. For certain loan types, you have Lennar Mortgage, which offers competitive rates, especially for FHA, which is around 4.85%, and VA, which is 4.98% in loans. Bank of America is next, which offers the Affordable Loan Solution Mortgage with a down payment as low as 3% and competitive rates specifically designed for first-time and modest income borrowers, right? TD Bank is next, which provides several affordable mortgage programs with down payments as low as 3% for first-time and repeat buyers. Rocket Mortgage is next, and Chase Bank, frequently recommended for first-time home buyers due to their range of programs and ease of use. Okay, you have specialty loans. So some lenders like Navy Federal Credit Union and Veterans United specialize in VA and military loans, offering lower rates for eligible borrowers. You have USDA loans. CMG Mortgage offers USDA loans with rates as low as 2.72% for qualifying borrowers in rural areas. There's personalized rates, so your actual rate and eligibility will depend on your credit score, your income, and other factors. So always compare personalized quotes from multiple lenders, okay? Now let's look at the next way. Lower your, total interest paid, by choosing a shorter loan term such as 10 or 15 years instead of the more common 30 years. So basically, it dramatically reduces the total interest you pay over the life of your mortgage. This happens for 2 main reasons. You have shorter repayment period. So with fewer years of interest to accrue, you pay interest for a much shorter, time. There's lower interest rates. So lenders typically offer lower interest rates on shorter term loans, further reducing your interest expense. For example, on a $300,000 mortgage, a 30-year loan at 6.5% interest would cost you $382,633 in interest, while a 15-year loan at 6% would cost you $226,950 in interest. So a savings of over $155,000 on a $500,000 loan. A 30-year term at 7% would result in $558,000 around there in total interest, compared to around $133,000 for a 10-year loan at 6%. A difference of more than, get it now, $425,000. There's faster equity buildup. So with a shorter loan, a larger portion of each monthly payment goes toward the loan principal rather than interest. This means you build home equity faster, much faster, giving you greater financial flexibility and the potential to access home equity for other needs sooner. So there's a quicker path to full ownership. So paying off your mortgage sooner means you'll own your home outright much faster, freeing up your budget for other financial goals such as retirement savings or investments, okay? But there are trade-offs. There's higher monthly payments. So the main downside of a shorter loan term is a higher required monthly payment, which may not fit every budget. There's stricter eligibility, so lenders may have tougher requirements for shorter term loans to ensure borrowers can handle the higher payments. Mortgage points, also called discount points, are upfront fees paid to a lender at closing in exchange for a reduced interest rate on your mortgage. So this process is often referred to as buying down the rate and can result in significant long-term savings for home buyers. Now here is how mortgage points work. There's the cost. Each point typically costs 1% of your total loan amount. For example, on a $300,000 mortgage, 1 point would cost around $3,000. Now the rate reduction is each point generally reduces your interest rate by about 0.25%, though this can vary by the lender. There's upfront payments, so the cost of points is paid at closing as part of your closing costs. So how points, save you money is basically the lower interest rate. So by paying points, you secure a lower interest rate for the life of the loan, which directly reduces your monthly payments and the total interest paid over time. There's loan or long-term savings. So the longer you keep the mortgage, the more you save. For example, buying 1 point on a $350,000 mortgage at a 7% rate can save you over $21,000 in interest over 30 years, even after accounting for the upfront cost. So monthly payment reduction is as goes. So lower rates mean lower monthly payments. For example, on a $431,000 loan, buying 4 points costing $17,240 could reduce your monthly payment by $287, saving you $10,000 plus over several years. There are tax benefits too. Points are considered prepaid mortgage interest and may be tax deductible if you itemize deductions, offering additional savings. Now, here are some things to consider. You have a break-even point. You may need to keep the mortgage long enough for the interest savings to exceed the upfront cost of the points. The selling or refinancing right before this point could mean you lose money. Now, this situation is best for buyers who plan to stay in their home for many years and have the cash available for upfront costs, benefit most from buying points. So you're going to want to consult with your lender. So rates and savings vary. So ask your lender for specific scenarios based on your loan details. Now let's look at the next way. Refinancing your mortgage means basically replacing your existing home loan with a new one, often to take advantage of a better terms of lower interest rates. So this financial move can save homeowners thousands of dollars over the life of their loan, depending on several factors. Now, let's look at the key waves. You have refinancing saves money, so lower interest rates, right? Securing a lower interest rate is the most common reason to refinance. So even a small reduction like 1% can translate to significant savings over the life of the loan. For example, refinancing a $300,000 loan, 30-year mortgage from 4% to a 15-year loan at a lower rate could save you over $100,000 in interest. There's the reduced monthly payments, refinancing to a lower rate or extending your loan term can lower your monthly mortgage payments, freeing up cash for other financial goals or expenses. There's shorter term loans. Switching from a 30-year to a 15 or 20-year mortgage means you pay off your home faster and pay less, much less, in total interest, even if the monthly payment is higher, right? Then let's look at eliminating private mortgage assurance. So if your home has increased in value or you've paid down enough of the principal, refinancing can help you eliminate PMI, saving additional money each month. So switching to a fixed rate also helps. So if you have an adjustable rate mortgage, also known as an ARM, refinancing to a fixed rate mortgage can protect you from future rate increases and provide predictable payments. Okay. So accessing home equity is a factor too. So a cash out refinance allows you to tap into your home's equity for major expenses like home improvements or debt consolidation. So often a lower rate at a lower rate other than other types of loans, right? Now, here are some considerations and costs. You have closing costs, right? Refinancing typically involves closing costs like around 2 to 5% of the loan amount, which should be weighed against your potential savings. So keep that in mind. There's the break-even point. So calculate how long it will take for your monthly payments or savings to offset the upfront cost of refinancing. If you plan to move before reaching this break-even point, lowering your debt-to-income ratio can have a major impact on both your ability to qualify for a home loan and the total amount you pay over the life of your mortgage. Now, easier loan approval and access to better rates is a factor. So lenders use your DTI ratio to assess your ability to manage monthly payments and repay borrowed money. A lower DTI signals less financial risk, making you more likely to be approved for a mortgage. Most lenders prefer a DTI ratio below 36%, and approval becomes much tougher above 45 to 50%. So borrowers with lower DTI ratios are often, offered better interest rates because they are seen as more financially stable. Now, here's how lower DTI translates into savings. So lower interest rates, right? A lower DTI ratio can qualify you for a lower mortgage interest rate. Even small reduction in your interest rate can mean saving thousands of dollars in interest payments over the life of a 15 or 30-year loan. There are better loan terms. So with a lower DTI, you may also access loans with lower fees, reduce mortgage insurance requirements, or more flexible repayment options, right? So avoiding higher cost loans. So if DTI is high, you may only qualify for loans with higher rates or additional fees, so increasing your total borrowing costs. Now let's look at this example. The impact of lower DTI on loan costs. Suppose to borrowers apply for a $300,000 30-year fixed mortgage. Borrower A has a DTI of 32% and qualifies for a 6% interest rate. Borrower B has a DTI of 45% and only qualifies for a 6.5% interest rate. The difference in total interest rate paid over 30 years at 6%, $347,515 in interest. At 6.5%, $382,633 in interest. That's a difference of over $35,000 in interest alone, just from a 0.5% rate difference due to a lower DTI. So to lower your DTI, pay off smaller debts first, to quickly reduce monthly obligations. You can refinance or consolidate loans to lower monthly repayments. That's what I have for you today. Take a moment to hit that subscribe button and the like button. I appreciate your viewership. See you in the next video.